drives the long end of the curve. In other words, the 10-year treasury yield. It's not the issuance. It's not how many treasuries or 10-year that Janet Yellen is issuing or Scott Bessent or anything like that. It's growth and inflation expectations. So what happens is when the Fed funds is coming down, the market is perceiving that to mean that growth and inflation is going to increase. Now, this could be short-term noise, which I think it is, like we saw back in the 2008. But if you think that one through, it's ironic, isn't it? Because if we had to pick out one interest rate or one maturity that has the most impact on the real economy, it would be the 10-year treasury yield. And so most people think that, well, monetary conditions have loosened dramatically because the Fed has dropped rates by 100 basis points. Have they? The long end of the curve has gone up by 100. So I think there's a strong argument that monetary conditions have actually tightened over the last 4 or 5 months, which again makes you question, does the Fed really control interest rates? Even at the front end of the curve. Because put yourself in the position of Jerome Powell right now. You just dropped by 100 basis points trying to bring down all interest rates. And the 10-year just basically gave you the middle finger and said, no, we're going up by 100. So, he's got to be contemplating the possibility that if he continues to drop, the 10-year might continue to go up, do the opposite of what he wants. So is he really controlling the front end of the curve, or is the 10-year treasury saying, no, Jerome, we control the game here, my friend, and you're not dropping rates? And people will push back on that and say, oh, George, well, the Fed is just going to come in and do quantitative easing. They're going to buy the long end of the curve, and that's going to bring interest rates down. Don't you remember, 2010 to 2020? Go back in the history books, look at some charts, and see what the 10-year treasury yield did during QE 1, 2, and 3, when the Fed was buying all of those treasuries, trying to get the long end of the curve down. In other words, get the yields down. The yields did the opposite of what the Fed wanted, even with all that additional demand. Why? Because the market perceived that to be inflation and growth expectations increasing, so they sold more than the Fed bought. My point there, start your analysis by looking at what you think is going to happen with consumer prices and inflation expectations in the real economy. Do that first, and then try to ask yourself how the Fed is going to respond in relationship to certain scenarios. And that's how you can kind of use some game theory to set up your portfolio, or know if, there's going to be an opportunity at the end of 2025 to refinance at a lower level. If you go back and look at QE, the Fed took their balance sheet from $800 billion straight up to, or where did it top out, $9 trillion, something like that. And let's just look at the DXY. The answer, the punchline there is a lot lower. So the Fed printed all of this money, and what did the value of the dollar do relative to other fiat currencies? It went up. My point there is that the Fed's balance sheet has no impact whatsoever on the value of the dollar. You could kind of argue it might have an impact on goods and services in the United States, but again, if we're just comparing fiat to fiat, that the Fed's balance sheet doesn't really make a difference. Over the short run, the interest rate can. Let's say the Fed is dropping rates while the ECB is increasing rates. Well, then, yeah, that's going to put downward pressure on the dollar relative to the euro. But that's going to be more so temporary. If you're trying to think through what impacts the value of the dollar relative to other currencies, you have to realize it has very, very little to do with the United States. It has much more to do with what's happening outside of the United States in the global monetary system and the banking system that's actually creating the majority of the dollars by lending them into existence. If things get really rocky, to your point, they'll probably go into treasuries, which then would lower rates, right? But again, that's because growth and inflation expectations, not just in the United States, but globally, are coming down. But I think that if we do have, let's say, a balance sheet recession in the United States like 2001, the economy doesn't do that bad, but it's just the stock market goes down by 50%. And maybe housing goes down by 20% in nominal terms or something. So a balance sheet recession. For me, especially if things got cheap based on the metrics I use, that would be a huge buying opportunity, because my base case would be that over the next 5 years, we're going to see that dynamic where it is much more attractive to invest in the United States or dollar-denominated assets than other places, and you're going to see those capital flows, which will be a significant tailwind. But again, notice I said tailwind. There's a lot of cross currents here. There's thousands and thousands of variables, and that's just one variable that we need to consider. There could be other cross currents that come along that overwhelm that dynamic. But that's why we got to stay focused on this stuff, and we can't just bury our head in the sand like an ostrich. So I think it's regional. DC is going to get completely wiped out. DC and Virginia, like Tyson's Corner, they'll probably have an economic depression there. It all depends if they're reducing regulations bureaucracy and red tape because we want the private sector to grow. We want the entrepreneurs out there. We want them out there producing more goods and services. So if you, let's say, fire 100,000 government workers, it's going to be bad for them. But on net balance, it's going to be a positive if you're reducing regulations, bureaucracy, and red tape, because that's what's going to allow the private sector to grow to the point where they're going to be able to create more than the 100,000 jobs that were lost by just getting rid of all the inefficiencies, which is the main objective of DOGE. You know, I applaud their efforts, but I always take a step back and say, remember, guys, this has to come with the reduced regulation. If you just get rid of, let's say, 100,000 employees and you don't reduce the regulations, then that could be a net drag on the economy, not just in the short term, but potentially in the long run as well. So we've got to compartmentalize things, right? We can't just say that because they're shining a light on all of this waste and all the grift, that is absolutely 100% good. But at the same time, if we look at it through an economic lens, it's going to be a net positive just so long as we focus on what we really need to. And that's unshackling the private sector so they can do what they do well. My point with Trump is, look, if you want to do this and you're looking at this strictly through a lens of taxes, right? Because that's what your question was. Now we could look at it through economics, through jobs, what it does to China, negotiating tactics. Those are all separate issues, right? But if we look at this just through the lens of tax revenue and, bring in more money for the government, my big thing is we've got to increase efficiencies. We've got to reduce the size of government, reduce it. So before we have an external revenue service, we need to eliminate the internal revenue service. We don't want both, because I know the argument is, well, once we get the external revenue service up and running and we're creating all this revenue, we're all going to be rich because we're making so much money in tariffs, then we can go ahead and reduce the IRS or eliminate the IRS. And I can assure you that's not the way it works. You're going to end up in 10 years with both, and the external revenue service is going to be even bigger of a monstrosity than the current IRS, and you're not going to have one of them. Like I said, you're going to have both. And by the way, you have to think this through, which I don't think many of the Trump fans have done. Because if you want to source all of your revenue for the government, let's say, through these tariffs, which is what Trump talks about going back to the late 1800s, early 1900s, but you also want to bring manufacturing back to the United States. You're saying you want to reduce the amount of imports. Okay, well, if we are successful in bringing all those jobs back to the United States, you're going to bring your imports down to almost zero. Okay, but that's where you're making all of your revenue. So the better you do over here, the worse with this plan, the worse you do over here. And I don't know how you square that circle if you're someone that believes in Trumponomics or something like that. I'd like to hope that the tariffs are just a negotiating tactic. But I think as far as an economic policy, whether it's through jobs or tax revenue or anything like that, I don't think it's a really good idea. Another thing that people don't really think through is every single good that we import into the United States already has a tariff on it. It's called transportation costs. So let's think about it. All else being equal, is it cheaper to buy a widget from China or from the United States, if assuming wages and everything like that are all the same? Well, it's going to be way cheaper to buy it in the United States. Why? Because you don't have that transport cost shipping it across the Pacific Ocean. That's not free. So that's a tariff. You're increasing the cost. And so we have those tariffs. So why haven't those tariffs created all these additional jobs or U.S. manufacturing? I think it's just a question that we need to ask. Look, this argument drives me crazy when I hear this on social media and whatnot. You're competing with a communist country, for heaven's sakes. You don't think that they've got any drawbacks to doing business in China? And I love the argument that, well, they're a currency manipulator and they have all these tariffs, so we need to have tariffs. Well, that argument is okay. Well, they're doing central planning so awesome that we just need more central planning to be able to compete with them. No, I've got an idea. How about free market capitalism? How about that? So they can do all the stupid tariffs against the United States. They can have cheap labor. They can destroy the environment. They can cheapen the yuan. They can do all that nonsense. Well, fine, but they still have central planning. And last time I checked, that wasn't very efficient, right? When you have to check every single thing that you do through Xi Jinping, you don't think that is a headwind to you doing business? Of course it is. And if in the United States, we don't have those headwinds, then that allows us to compete. I use the example of basketball. Let's just say they've got a 7-foot guy, and we're saying there's no way we can compete with them unless we have a 7-foot guy. No, that's not true. We just need a 6'5" guy it's a hell of a lot faster. And then we're going to beat them every single day. So I would much prefer to make our businesses or our products, let's say, a lot better. And that's how we compete with them, instead of just making their products a lot worse, right? Because at the end of the day, if all we do is just make their products worse, in other words, more expensive, then that's just going to impact the consumer, right? And then the consumer loses, and you say, well, we've got all these jobs, great. So let's just think that one through. So you increase the prices at Walmart that has, let's say, 100 million American shoppers on a weekly basis just to bring back 10,000 manufacturing jobs. That doesn't make a lot of sense to me. And then another thing you have to think about is the strong dollar. And if you have a strong dollar, that could completely offset the tariffs. Because if I'm a Chinese producer and I've got a 25% tariff, if the dollar goes up 25% relative to the yuan, I can just lower my price by 25 and I still get the same amount of yuan cash flow to pay my expenses. You see, so there's a lot of these factors and people like to look at it through a lens that's oversimplistic. And I think when you do that, you lose a lot of the accuracy. But again, it goes back to the fact that these tariffs are fantastic negotiating tools. There is no doubt about that. But as far as an economic policy, you've just been sold oceanfront property in Arizona.